The United States government just blinked. For half a century, the financial elite have upheld the facade that silver's price is dictated by a New York computer. They've insisted that paper contracts, lightning-fast algorithms, and leveraged derivatives drive true price discovery. They've dismissed physical supply as meaningless, claiming, "There's always ample metal circulating." But today, Wednesday, January 14, 2026, that deception crumbled. We have obtained an official dispatch from the United States Mint, the sovereign body tasked with minting the nation's constitutional currency. To the untrained observer, it appears as a routine customer notice, but to the sharp-eyed investigator, it's an admission of profound systemic collapse. The United States Mint has halted all sales of silver numismatic items. Let me emphasize, the US government has ceased selling silver. The reason? Their notice cites pricing recalibrations amid surging silver values, forcing a temporary shutdown until they can recalibrate product costs. This isn't a minor tech hiccup or a site malfunction, it's a sovereign-level physical shortfall. Consider the ramifications. The Mint isn't a speculative trader or a hedge fund. It's a treasury-backed manufacturer. If they can't swiftly price a 1-ounce silver coin, it signals market turbulence, overwhelming bureaucratic machinery. It reveals that the flickering $89.67 on trading screens is racing beyond governmental grasp. Yet, a more chilling undertone emerges. Businesses halt sales during spikes when restocking becomes impossible. If the Mint sells a silver eagle for $100 today only for silver to leap to $110 tomorrow, they've hemorrhaged both money and the irreplaceable ounce. Worse, if refiners' stocks are depleted, they're essentially bartering national reserves for fading fiat. They've awakened to silver's superior worth over dollars. This halt is the emergency alert we've long anticipated, the rift where paper valuations and tangible reality clash, paralyzing the apparatus. We're entering the no-bid stage of the bull surge. Picture entering a supermarket stocked with milk and bread, only for the cashier to refuse your purchase, citing skyrocketing prices and suspended transactions. What does that imply? Currency erosion. The proprietor prefers hoarding goods over accepting your notes. That's precisely what Uncle Sam just imposed on its citizens. This mint freeze will ripple through the dealer ecosystem like a seismic wave. Private outlets like APMEX, JM Bullion, and SD Bullion rely on the mint for cues. With the mint barricaded, dealers spiral into alarm, recognizing their pipeline for the globe's premier coin, the silver eagle, has been severed. This ignites a scarcity vortex. Premiums skyrocket to safeguard dwindling stocks. Without fresh eagles from the feds, rationing ensues. We're witnessing eagle premiums shatter records, decoupling wildly from the $89 spot. And now the charts tell the tale. As the mint idles, the market surges. Silver clocks in at $89.67, climbing $4.5 today, a blistering 5% gain. We're teetering on 90's brink. Yesterday's botched assassination attempt and ineffective margin spikes have galvanized the bulls, who now scent vulnerability. Traders detect even the government's desperate scramble for metal, preempting the repricing blitz. $90 looms as a mental milestone, but $100 is the pivotal threshold. The Mint's lockdown ensures we'll breach it by choking off vast retail supply. Ounces earmarked for public sale today now languish in vaults, inaccessible. That desire doesn't evaporate, it intensifies as denial fuels craving. This suppressed demand cascades into alternatives, bars, rounds, broader investments, generating a suction force. Inadvertently, the US government has unleashed silver's grandest promotion ever, affirming its supremacy by barring access. What's next? The Mint pledges resumption post-repricing, but anticipates steeper tags. They're adapting to a triple-digit norm. This juncture marks the divide. Pre-today, a mere squeeze. Post-today, sovereign turmoil. The money printers can't procure the metal. If that doesn't expose the dollar's frailty, what will? The Mint has capitulated. Dealers are allocating sparingly, and prices ascend vertically. But if the Mint's retreat was defensive posturing by the powers that be, the commercial vault's upheaval signals aggressive strikes from the titans. While authorities barred retail silver, a colossal player siphoned 1.3 million ounces from JP Morgan Chase's vaults. In the forthcoming segment of this probe, we'll dissect the JPM exodus, probing who wields such clout for daily mega withdrawals and why eligible category drains spell doom for COMEX pricing. The regime conceals the metal. Wales sees it. You're faced with a stark decision. Trust the spin or the barren racks. If the Mint sales freeze was the elite's guard, yesterday's vault action was a bold counter-offensive. As everyday folks learned they couldn't snag a 1-ounce coin, a shadowy force infiltrated the planet's most fortified depository, extracting over 1.3 million ounces of silver. We've scrutinized the CME Group's daily stats from late yesterday, unveiling a targeted assault on JP Morgan's reserves. JP Morgan isn't merely a lender in silver, they're the citadel, guardians of COMEX's vastest cash. For years, their vaults were deemed the ultimate safeguard, presumed inexhaustible amid crises. Yesterday, that stronghold cracked. Precisely 1,302,807 ounces vanished from JP Morgan's lair, not reclassified, but outright withdrawn, trucked away, excised from COMEX forever. Who commands the resources, funds, and infrastructure for shifting 40 metric tons daily? Not hobbyists or small-timers, this reeks of sovereign funds, central banks, or industrial behemoths. And it wasn't isolated. 600,000 ounces fled Brinks, 200,000 from Cient, 259,000 from Loomis. System-wide, COMEX hemorrhaged nearly 1.8 million ounces in a day. This mirrors a bank run, but with strategic titans queuing at warehouses for bars instead of cash. Their motive? Counterparty peril. These extractors sense the $89 screen price is illusory. Inventories are evaporating, and vaulted metal risks entanglement in banks' short-covering schemes via leases or rehypothecation. Thus, they claim custody, adhering to the axiom, if you don't grasp it, you don't possess it. But this pullout harbors a profoundly bullish nuance: its vault origins. COMEX divides silver into registered futures, deliverable and eligible, privately stashed. Squeezes typically erode registered, which dipped 500,000 ounces yesterday. Yet JPM's bulk exodus hailed from eligible, the sticky trove of fee-paying long haulers. When eligible flees in chunks, it betrays veteran holders' exodus, eroding faith in the exchange's sanctity. Where's this bounty bound? Global pricing clues point eastward. China's silver fetches 98,100 versus New York's 89 and $11 arb gap. Savvy holders ship from suppression zones to premium payers, draining west to nourish east. Yesterday's JPM haul likely jet-specific bound now. This outflow caps suppression's lifespan, infinite paper shorts. Meet finite atoms. Daily 2 million ounce leaks could cripple COMEX availability in weeks. This loops to the mint's impasse. Wholesale drains starve retail pipelines. Big players devour upstream, leaving downstream buyers parched, a crowding out spectacle. At $89.67 with 5% daily pops, we're skating on fumes, buttering ghosts of vanishing metal. The JPM siphon is irrefutable proof. Elites aren't dumping at 89 there. Claiming it, betting it's undervalued, priming for a seismic repricing. Government sales shuttered, bank stocks ebbing. This spotlight's one query: how lofty must prices climb to staunch the bleed, luring whales to redeposit? Above Shanghai's bid, beyond street premiums. In our next dive segment, we'll unpack Shanghai's truth serum, where 98,100 silver mandates COMEX's instant $100 leap. The void gapes, tension mounts, the levy teeters. The mint sealed, vaults ajar, fortunes shift. We've reached reckoning hour. In segment 1, the US mint barricaded amid pricing paralysis. Segment 2, whales pillaged JPM's hoard, distrusting silver's haven. Now, segment 3 confronts the spectre tormenting London and New York bankers, silver's authentic value. Your screen flashes 89.67, the COMEX algo's decree, media's echo. But Eastern dispatches shatter this. China ease physical silver swaps at 98,100, dual planetary prices. Westie's 89 paper versus Eastie's 100 tangible and 11 chasm. Not a quirk but a maelstrom devouring Western ounces. For arbitrageurs, banks, refiners, traders, it's a no-lose gambit. Snag COMEX at $89. Deliver, jet to Shanghai for $100, pocketing 10% swiftly. This vortex explains vault voids and mint moratoriums. Metal gravitates to peak payers. China, this heralds economic tectonic shifts. For decades, New York or London dictated values. East complied, now inverted. Shanghai commands, New York trails, anchored in industrial hunger for solar, batteries, wealth shields. COMEX must ascend to $100 or bleed dry, averting default via gap closure, fueling chart ferocity. China's $100 bids stem from inelasticity, no waiting for dips in strategic essentials. They're amassing for green dominance, unfazed by costs. This elucidates mint mayhem. Suppliers spurn $89 offers, favoring Shanghai's $100. America outbid in its domain currency's dawn demise, where producers shun fiat for vanishing goods. Bifurcated realms, crumbling paper, surging physical. For imminent action, Shanghai's $100 obliterates COMEX ceilings traders chase, Funds pile in via futures amid physical famine, spiraling headlines, retail frenzy, premium spikes, super exponential territory. Gold's $4,616 steadies, but silver outpaces, ratio compressing from acute shortages versus gold's monetary uplift. Shanghai's unforgeable bids indict COMEX's $89 as fraud, punishing decades of manipulation with drains and defaults. The beach ball erupts. In this probe's finale, we'll chart triple-digit trajectories, mint revival prospects, and positioning tactics as paper bows to Shanghai's dawn. $100 isn't aspirational, it's present. Just veiled on your feed. Tomorrow's here, Shanghai bound. We've culminated. If you've traversed this exhaustive analysis, you grasp the cataclysm's scale. Mint's sovereign stutter, JPM's 1.3 million ounce heist, Shanghai's $100 eclipse of COMEX fantasy, irrefutable forensics herald an epoch's demise cheap, paper-flooded silver's obituary, dated today, January 14, 2026. Gaze ahead. Rules warp post-mint lockdown, vacuum navigation, halting point. Not $90, nor 100, that's the psyche's Rubicon, shattering poor man's gold myths. COMEX's imminent $100 sink sparks media maelstrom, inverting demand, higher prices beckon hordes, Giffen style, Mint's barrier amplifies lust, reopening unleashes cued buyers at premiums, $100 launches mania, but dollars debasement. Underpins, bonds to commodities, sovereignty erodes sans cheap loans or resources. Resist 9100, sell lures swap not for depreciating fiat, but ounces for assets. Land ventures yields, at $90, silver merely inflation adjusts. Peaks loom, historic ratios peg $300 plus targets amid 51-to-1 gold-silver skew versus geologic 15-to-1. Chaos brews, banks faints, margin ploys, supply whispers dismiss, track vaults outflows, Shanghai's bids, dealers hikes. Fundamentals ironclad. $20 silver extinct, resource nationalism reigns, government confessed via shut down your queue, secure holdings privately, snag remnants at 9100 over flaming paper, Mint's default seals breakage. Transfer favors metal trusters, Mint barred, vault exposed, ascent shear, subscribe,